We're diving straight into an analysis report on energy fuels, ticker UUU. And it's asking the big question, is this recent 7.8% surge the start of the uranium supercycle?
Yeah, this is exactly the kind of thing we love to see. It's timely, it's got high conviction. We should probably just get right into it.
Okay, so let's start with what's working. The report does a really good job making a fact-based case right up front. It highlights these really impressive concrete data points. The stock closing at 1507, decisively above that $15 mark.
Which is a big psychological level.
Exactly. And it's backed by massive revenue growth, over 100% year over year, and a really strong balance sheet. We're talking $94 million in cash and almost no debt.
That financial foundation is solid. And I think the timeliness is a real strength. It captures the momentum perfectly by starting with that technical breakout.
Right.
But what I really appreciate is how it anchors everything to that competitive advantage, the energy independence angle.
The White Mesa Mill.
Exactly. Owning the only conventional operating uranium mill in the entire United States, that's not just a trivia point. It's the core operational moat. It's what sets UUU apart.
I agree completely. That part gives the whole premise instant credibility. But, and this is our first major point, let's talk about the framework all this great data is wrapped in.
Okay.
The material's highly sensational language. It risks undermining its financial credibility, especially for more sophisticated readers.
That's a critical observation. Yeah. When you're trying to justify 100% upside potential, the tone matters just as much as the data.
If it sounds like, amateur enthusiasm instead of strategic foresight, you could lose that institutional reader before they even finish page 1.
Exactly. The notes here show the current tone is using emotional, almost hyperbolic phrasing. I mean, it seems tailored for a high-energy video or something.
Right.
Phrases like, the stock woke up and chose violence, or that it ripped higher. I mean, that stuff drives engagement, for sure. Gets retail attention.
Of course.
But it clashes pretty sharply with what you'd expect from a formal, rigorous financial analysis report. The language is sort of selling the trade, not building the long-term investment case. I see what you're getting at. So the suggestion is really to calibrate that tone, move it from emotional hype to, let's say, strategic confidence.
Yes, that's a perfect way to put it.
You have a huge story here. Cash rich, zero debt, the only mill, massive analyst targets like, $28.09? The analysis should just let those compelling facts speak for themselves. You don't need the viral sound bites when the fundamentals are this strong.
So, for a concrete example, instead of saying the stock is rocketing up nearly 8%, we could suggest something more measured.
Like what?
Something like, energy fuels posted significant gains, rising 7.80% in heavy volume. It's a small shift, but it acknowledges the move while staying objective.
And you could apply that same thinking to the psychology part, framing it as smart money stepping in. That's a vague, overused term.
It's retail jargon, really. It is. You could elevate it by being more precise. For example, a sustained closing price above the key $15 resistance level validates institutional conviction in the long-term thematic drivers, right? That feels more solid.
It shifts the focus from, a fleeting emotion to a verifiable trend. It speaks the language of capital, not just enthusiasm.
That's an excellent distinction. You keep the bullishness, but you frame it in a way that just elevates the whole analysis.
Precisely. Let the $94 million in cash be the loudest voice, not some excited adverb.
Okay, let's move to our second area of focus. The analysis needs to deepen the foundation of the long-term supercycle thesis to logically justify that projected 100% upside.
This is about structural integrity. The supercycle is the big picture, the forest. But we need to see the actual path UUU is taking through it.
And right now that path is, it's sketched out pretty thinly. The weakness here is that the report jumps. It goes from these huge macro drivers, AI, data centers, electrification, cutting off Russian supply.
All the big tailwinds.
Right. And it jumps straight from that to UUU's current financial status and its trading levels. The connection between that explosive global demand and how UUU actually captures that profit, it feels a little weak.
That gap can be a fatal flaw. It makes the 100% upside feel arbitrary. The report says tech giants like Microsoft and Amazon are looking at nuclear.
Yeah, very powerful narrative.
It is. But the analysis doesn't fully develop the link. How do those multi-billion-dollar contracts actually land on White Mesa's desk, specifically? Without that mechanism, UUU just seems like a passive beneficiary, not the primary architect of the solution.
We need that bridge, from the macro thesis to the micro operating leverage. So the suggestion is to expand Section 2 and really flesh out that supercycle narrative.
Okay,
And that expansion has to focus on the mechanics of how the supply crunch turns into guaranteed contracts and huge profits for energy fuels.
Right. You need to operationalize the supercycle. So for a concrete example, what if we move beyond just the existence of demand?
How so?
Well, what about adding a section that details the projected capacity utilization increase needed at the mill to meet U.S. energy goals? Show the math. If the U.S. needs X more pounds of uranium by 2030, what percentage of White Messe's capacity does that eat up?
That shifts the focus from potential to actual pressure. And, to tie it back to the valuation, the report mentions that $28.09 analyst target. That implies a huge amount of growth.
It does.
So we could advise detailing how spot prices would have to accelerate, towards that implied $100 plus level for those targets to even make sense.
And what specific milestones does UUU need to hit to get there? In terms of production, ramping up their assets, how do they leverage that demand spike from AI?
Exactly. If the analysis can successfully argue why UUU is best positioned to capture that value when spot prices are hitting triple digits, maybe because it's the only licensed domestic asset ready to go.
Then that $28 target starts to look logically sound, not just aspirational.
Right. It shifts the entire analysis from the supercycle is coming to this is exactly how UUU is engineered to monetize it. Much stronger.
Much more investable.
Absolutely. Now for our final point. To be a truly robust analysis report, the material has to integrate a discussion of potential risk factors.
This is the credibility test, isn't it? A report with only strengths is basically a marketing piece.
It is. A real investment analysis needs that balance between conviction and a sober caution. It just signals intellectual honesty.
And the weakness here seems pretty clear. The report is overwhelmingly bullish. It's all revenue growth, cash on hand, high price targets.
It assumes the bull case just plays out without any friction, which is, well, it's unrealistic, especially in a sector like nuclear.
Heavily regulated, complex, yeah.
So the suggestion is to dedicate a section to the key risk factors. Identifying potential pitfalls doesn't weaken the argument. If anything, it enhances the credibility. It shows you've thought past the easy win.
That's a great point. And a key risk here is just the timeline, right? The market is pricing in future demand, but infrastructure buildouts are notoriously slow. So as an example, we could suggest integrating a discussion that asks, have we considered the political or regulatory risks? Permitting delays for these kinds of projects are common.
That could push the timeline for demand way back, impacting cash flow.
Easily, regulatory shifts can add years to a mine's development schedule.
And the risk should be specific to UUU. What about the execution risk of ramping up White Mesa? It also processes rare earths, right?
Yeah, there's an operational complexity there.
If they focus too much on one, do they miss the opportunity in the other? That needs to be at least acknowledged.
And we can tie this risk directly back to the technicals. The report identified $14.30 as the new support level. That's good.
But
a full analysis needs to define the point where the whole thesis breaks down. A stop-loss perspective.
okay,
So we could advise identifying a lower support level, maybe the old consolidation base, around $12.50 or $13. That, if it's breached, it functionally negates the bullish breakout thesis.
That provides a clear line in the sand. If the stock drops below that, the reader knows the market is rejecting the timing of the supercycle and they need to reevaluate.
It's about capital preservation. A complete analysis needs those parameters defined. It's the difference between a high conviction call and a responsible investment thesis.
Excellent.